This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
This is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant currency on the planet. I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Over the next hour, we're going to dig inside the big business stories impacting Wall Street and the global markets.
Each and every week, we provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide.
Today, we're going to take a look at the dropping water level in the Rhine River, which will threaten to raise prices all over the place, particularly when it comes to chemicals.
Plus, how the TMT bubble, that's tech, media, telecom, is a threat to stocks.
That's like your home.
That's
there, man.
it.
All right, but first let's take a look at FX for a moment. The U.S. dollar, has it peaked out? Will it continue to climb? Is it in a win-win position? We're going to break this down even more with Bloomberg Intelligence analyst Audrey Childe-Freeman. Audrey, the dollar has been giving up a little bit of its gains recently, particularly as yields have kind of recalibrated. What's the direction of travel?
Okay, so let's start with numbers. So if you look at the DXY, we still we were up about 15% over January to the mid-July high, and we've come down about 3.5% from this mid-July high. So what I'm trying to say here is that if you pull a yearly chart, it's still looking very healthy, very strong for the dollar. However, we have seen a pullback, and it has been quite, the kind of magnitude has been quite sharp in a short period of time. And that's why we're all wondering, what to make of this. And so the first conclusion I make at this point is that it is too early to say that the dollar has peaked. If you look at the drivers that have been driving the dollar higher throughout the year, I think they remain in place overall. The dollar may be overvalued still, and the longs were overextended. But for now, I'm more in the camp of saying this is just a pullback rather than a change in trend and a change in direction.
Audrey, if I look at, we've got our Federal Reserve hiking rates. The question is, how aggressive will it be? There's some debate there. But in any case, it's certainly behaving more aggressively than most other central banks around the world. Doesn't that in and of itself argue for a bull case for the dollar?
That's precisely one of the key reasons why, for now, I'm reluctant to changing the outlook for the dollar. It is, first of all, the markets this week with the softness in the CPI is kind of wanting to buy in a more dovish Fed. But the Fed has yet to tell us that they're going to be more dovish. Mm-hmm. In fact, most of the comments that we've had from Fed members keep on telling us we are going to commit to what we said, and we're going to hike more. Okay, maybe we only see 50 and not 75 in September, but the Fed has a long leeway in terms of how much they've done in raising interest rates and how much more is to come. So this is my first point, that whatever way you look at it, and when it comes to yield differential, the Fed will continue to be more favorable for the dollar bullish view for Audrey, the time being.
But I wonder how much of that was already priced in, that we'd see a stronger dollar if you got a 100 basis point hike. But if we wind up getting 50, or I know the JP Morgan Asset Management sees a 25 basis point hike in November and then they're kind of done, like they hike until then they're done. If that happens, do we just not get further strength? Maybe it bases around this level, but you can't get that next catalyst.
Yeah, I think that's the point. At that point, you start to think about relative yield differential, what's expected versus what we actually get. It will be a question of watching the data. And at the moment, because of the softness in the CPI and the PPI, the market is kind of thinking, okay, this relative rate story is not all that bullish anymore. But just be aware, CPI, we can go through the number and highlight that the core elements was still quite strong. And don't forget, this is a 1 month data. Let's wait a little bit. Let's see what we see in August and September, and then we can, I think, have more of a strong view as to whether the dollar really has peaked.
Audrey, all the travel agency sites over here, they're all saying you got to go to Europe, take advantage of the strong dollar, which certainly makes sense. But I can't even see a bear case for the dollar. What is a credible bear case for the U.S. dollar? Particularly
with Europe potentially having to hit a recession because of all the energy stuff.
Exactly.
Yeah, I mean, that's taking us to the other part. Okay, we've discussed all the U.S. drivers. So now look at Europe. If you look at euro dollar, so in Europe, I think for me, what could be a catalyst to becoming more bullish on the euro is if we go through the winter months with no more dramatic hiccup on the Russia-Ukraine situation, and in particular, once we have more information regarding Russian decision on gas supply to Europe and to Germany. This is the most critical point, I think, for Europe in the next few months, weeks/months. And until I'm more comfortable with what's going to happen there, I wouldn't jump into the euro. The catalyst at some point could be that we become also bearish on Europe and so much bad news is priced in Europe that actually in the end, it's okay. I mean, we still have to see a negative GDP growth in Europe. We haven't yet.
Really, really great stuff, Audrey. We super appreciate it. It is a confusing time, to be sure. Audrey Childe-Freeman, Bloomberg Intelligence, Chief FX strategist.
Coming up on the program, water levels on the Rhine are dropping, but that doesn't mean everything is dropping with it.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 13 minutes past the hour, and this is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Water levels on the Rhine River in Germany are absolutely at the lowest levels they've been seen in the longest time, 16 inches of depth in some parts of the Rhine. That's a problem for a lot of people. That's a problem for a lot of industries, including the chemicals industry. And to tell us why, we welcome Bloomberg Intelligence Senior Analyst Jason Miner. Jason, I've seen pictures of barges kind of floating up and down the Rhine, kind of getting stuck. How does that impact, your business, Global Chemicals?
Well, it's a huge impact on our business, and then it's an even larger impact when you think of the spillover effects. So, just directly, in our chemical industry, shipping accounts for like 5 to 7% of the value of all the chemicals that are sold. In most developed countries, that's true in Germany as well. The 2018 was the last time we were at these levels. The impact there, if you just take BASF, which is the German behemoth, they had an earnings hit of about 3%. We were about this low then. I should say this is only the second time we've been this low in 15 years on this critical shipping point. It's really critical for all of Europe. But that only lasted back in 2018 for about a month. And another question is, how long will this last? We'll be hoping for rain. Mm-hmm. So the direct impacts are pretty abrupt, and it's very hard to estimate what will happen when you start putting it all on trucks. And the trucks are all consuming diesel, and diesel's not cheap.
Well, okay, yeah. So there's a lot to unpack with that. So first, Jason, how much petrochemicals are transported on the Rhine? And can they be transported by train or by truck?
So we calculated it's about 10% of all of Europe's chemical shipments. And so it's a similar amount for Germany. It's really the backbone. Goes from Switzerland all the way down to the Amsterdam, Rotterdam, Antwerp port. That understates it a little because most of the molecules that come out as a finished product went in as under the classification of an energy product. So, you might have you have problems both ways. And so even if you brought in an energy product on the Rhine and then you turned it into a product and then you trucked it away, that's going to also be hit. Now, can they be shipped on rail and truck? Well, everything has a price. Back in 2018, a lot moved to rail. Rail, like in the U.S., is very tight in Germany now. In fact, there were just some outages because of electricity problems in northern Germany. So that system is stretched. We all hear about the supply chain problems, right? But supply chains are stretched. Trucking, Germany faces chronic shortage of drivers, which is like 30 to 40,000 drivers a year. A lot of those are Ukrainians that are unfortunately now going back home.
Wow. Yep.
And so that's getting worse. So the options are thin, and like everywhere, the networks are stretched.
All right, so we know we have a problem on the Rhine. How about some of Europe's other rivers, like the Danube and the Seine and things like that? Are they experiencing similar things, or is the risk there?
It's all over Europe. I mean, the Danube, yes. Saw a horrific picture of where, you've got, this is tangential, but you've got the tour operators on the Danube are cutting their routes. You can't sightsee like you did. There's pictures of stairways to the air that used to go down to the boats. It's very widespread.
Wow.
As you move outside of Germany, you get into some other basic products like fertilizer, let's not forget. And those things have a huge multiplier effect on the economy. One stat that just on terms of the spillover effect, which we can get into, you look at the U.S., for example, chemicals are around 3% of the GDP, but the American Chemistry Council claims they're critical to about 25% of U.S. GDP. So remember that these are molecules, but they're essential. Think of like the chip shortages and how it affected autos. Mm-hmm. It's a small part, but the spillover effects are just vast.
So to reduce this, basically, can you still get the chemicals that you need? You just have to pay through the nose for it? Or is there going to be a point where you're like, I have the money to spend and I literally can't get my hands on it because of the transportation problems?
Yeah, I think the transportation problem is going to reach the point where you can't get it done at any cost. Now, to what degree, and it'll be a gradient there, right? So for the lowest price commodities, it'll just make no sense. It's really, we haven't seen a perfect storm like this. The other thing lurking in the background is we have these enormous surges in raw materials or in natural gas and energy costs, right? So the purest straight from energy chemical really is like a nitrogen fertilizer. The nitrogen fertilizers are trading right now at about 3 times their historical average price. Plants are shutting down. And so, where you might have said, okay, well, we can tweak a little, we can adjust. Chemical companies are very flexible at using things for other things. The options are just getting thin. So I think shortages are not unlikely.
All right. Well, on my way home tonight, I'm going to check out the levels of the beautiful Passaic River, which runs behind my crib. Not that any, commercial traffic goes down, but I'll take a look.
Important as well.
It's very important. So, all right, let's talk about your universe of stocks, Jason. Give us a sense of how they've been performing throughout the pandemic as they deal with supply chain issues and inflation, and kind of what's the outlook for global chemicals?
So actually held up remarkably well and outperformed during the pandemic. And the reason for that was, I think none of us expected, though maybe we should have, how well packaging, things like medical materials, these were really, when you moved from eating at a restaurant to eating at home, you were buying everything in a clamshell. The packaging demand actually grew mildly during the pandemic. So while everything pulled back in the beginning of 2020, chemicals came roaring back in 2021. This year, we've got two things. We've had this long-awaited oversupply situation. A lot of that was created by new capacity in China and the U.S. That's lurking out there. I don't want to mix the picture too much, but we had that big Texas freeze in 2021 that kind of tightened the world. And so that helped us a little, too. All of that is passing. We're heading into oversupply. The cost picture is just staggering. I mean, we're facing 10, 20% increases easily in our costs in most of them. U.S. is ahead of the rest of the world because, remember, we do have cheaper nat gas availability, but we're raising prices at, a 9 to 15% clip across the complex. And the real question now is, with more supply, when are consumers going to pull back? We're starting to get, I think we saw Trex the other day, right? They make plastic decking. They're saying, we're seeing a backup into the fourth quarter. Their end market's not as strong. There's a point at which down the chain from us, we can pass these prices on, but people start to pull back. And that's really the concern now is, can demand keep up? It's looking less likely.
All right, good stuff.
Yeesh.
Jason Miner.
Bumming us out.
I know, but I tell you, chemicals, when you read his research, it's like chemicals are everywhere. You dismiss me as like not a fun industry, but we're everywhere.
You wear them.
I know
basically.
You wear them. All right, Bloomberg Intelligence Senior Industry Analyst Jason Miner.
All right, coming to the program, more yield curve inversion on the way. We're going to tell you why.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney.
And I'm Alex Steele. It's 25 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
We'll be here each and every week at this time, tapping into our Bloomberg Intelligence analysts, covering some 2,000 companies and 130 industries worldwide.
So the theme of this week was not only the rally that we've seen in the equity market, but also what we've seen in the bond market. And that's the re-rating in the front end as we kind of price out even a more aggressive Fed. So let's break it all down and what we can expect with Ira Jersey, Bloomberg Intelligence Senior U.S. Rates Strategist. Ira, is the path of least resistance an inversion that stops and maybe inverts less? Is it a steeper curve? What is it?
Yeah, we've been all over the place the last week, where after the payrolls report, the Friday before last, we ended up with a significantly flatter curve. In fact, the flattest yield curve that we've seen in almost 40 years. And then, since then we've come back a little bit. I don't think that the trend to a more inverted curve is over yet, because I do think that the market is mispricing the Fed's resolve a little bit here, where the Federal Reserve is still going to be very worried about inflation, even though this past week's CPI report wasn't quite as severe as some people had thought it would be.
All right, so I think if I were to summarize what the market's reaction to the jobs data, the CPI data, the PPI data was maybe, just maybe, this Federal Reserve does not need to be as aggressive as maybe we initially thought, if they are in fact data dependent. So maybe 75 basis points isn't a given. How do you think about that?
Yeah, I don't think that the Fed will necessarily go 75 basis points in September unless the August CPI report is very high. Remember, we got a whole nother month's worth of data. This is like the one time of the year that we're going to have an 8-week period between meetings. So the Fed's going to get 2 sets of data. So we'll have to see what the August data is before we can definitively know if they're going to go 50 or 75. But I think at this point you'd have to think that the Fed is going to go 50, and then they might go 25 or 50 later. So from my perspective, Paul, it's not whether or not they go 50 or 75 at the September meeting, but it's how many more times do they hike after that? Because the market's thinking, even if they hike 75 in September, they're probably only going to go one more time after that and stop, or they're going to go to 50 basis points twice and then again and then stop. And that's not something that I think is likely to happen, because the decline that we started to see in headline inflation and some of the other very few inflation measures kind of discount the fact that we're seeing core services prices continue to climb very dramatically, and that's something that's going to keep inflation much higher than the Fed wants. So it means that I think the Fed's going to hike more, and you've even heard almost every single speaker since the July FOMC meeting say, hey, we're going to be hiking in 2023. So that means they're going to be going more than 100 more basis points, probably 150 to 200 basis points more from here. So that gets you above 4% on the Fed funds rate, and the market's not pricing for that at all.
Yeah, not at all, and does not seem to be listening either, which is why I was also confused at the tail end of this week, and this was right after the PPI, so, you got to take it with a grain of salt, too, is the increase in the back end of the yields and a sell-off in the back end. I feel like we see that when we get worried about a recession, that the Fed's going to hike too much, but that's not what we were seeing in the front end. How do you explain it?
Well, I think the sell-off in the back end is just the idea that maybe the market's coming to the realization that the Federal Reserve, once they hike to whatever level they hike to, 3.5%, 4%, whatever, that they're going to keep rates there for some reasonably long period of time, longer than maybe the market was priced for before the PPI report. That's part of it. And I think some of it, too, is we're just talking about illiquid summer trading. And, people were in yield curve flatteners and they want to take a long weekend and go to the shore or do whatever, make a run to the Hamptons Friday morning. So they're getting out of risk. And in doing so, they wind up steepening the yield curve pretty dramatically for a short period of time. But again, I think that it's a little bit more technical, and it probably won't persist. It's more, everyone's position for the flattening trade. We occasionally have to have these reversals in that trend just to shake out some of the weak hands.
I've been trying to pitch to my bosses that they have to send me out to Jackson Hole, Wyoming.
He
Wyoming.
wants to go. I don't understand this.
So Jackson Hole, Wyoming, tell us what happens there during the month of August, and should I be going?
So if you want to hear from a lot of different speakers about monetary policy and this year, presumably they're going to be talking a lot about inflation, obviously, and maybe the effect on the consumer and the household sector. The Jackson Hole Symposium is just a meeting of central bankers, and there's a lot of high-profile policymakers from around the world that descend on Jackson Hole for a little bit of a junket. And but you do have Fed Chair Jerome Powell will be speaking, and we'll have all eyes on him because, like I mentioned before, we have this very long period of time in between Fed meetings, so it's almost like a kind of an intermeeting Fed meeting, so he can really calibrate where the committee and he himself are thinking that monetary policy is going to go.
Ira, thanks a lot. We really appreciate you've been right on so many things, particularly that inversion that we've seen. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist.
Coming up on the program, lots of talk about telecoms. Up first, how a new tax act actually harms them, despite being great for clean energy.
You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on some 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alex Steele.
And I'm Paul Sweeney. It's 39 minutes past the hour, and this is Bloomberg.
You're listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Congress finally gets it together. We have the U.S. Inflation Reduction Act. It's a health care bill, a tax bill, a green energy bill. Who is it good for? Who is it bad for in terms of industries? There's going to be a 1% excise tax on future buybacks. Well, joining us now to break it down is Bloomberg Intelligence government analyst Andrew Silverman. Andrew, who are the big winners? Who are the big losers in terms of industries in this bill?
Well, I think for the most part, this is great for all companies. I mean, tech companies probably not as good as others. Maybe telecoms not as good as others. It looked like manufacturers might have an issue, but that was really changed in the bill by Senator Sinema. So these taxes aren't actually that terrible. And bigger companies as well. I mean, Apple, because of all the stock that they buy back, and companies that have pretty low effective tax rates, but make a ton of money. Those companies might have an issue with this bill.
Yeah, talk to me about that. I mean, one of the things that got my attention, the minimum tax, and it just seems like that minimum tax, tell us what it is, but it just seems like it was designed for all the stories you read about, all these big tech companies making gajillions of dollars, but they don't really pay any taxes because they kind of work around it.
Right. So this is actually a blast from the past. We used to have a corporate alternative minimum tax that was repealed by the Tax Cuts and Jobs Act. And this is kind of like that alternative minimum tax, but much more so. This is like an alternative minimum tax that we had from 1987 to 1989. And that tax was called the BURP tax.
Oh, boy.
It was the Business Untaxed Reported Profits Tax.
Who makes up these names, honestly?
Yeah, and we abandoned it because, the Assistant Secretary of the Treasury testified for Ways and Means. He said it was having a detrimental effect on the quality of financial reporting. In other words, companies were changing the income that they were stating on their financial statements in order to reduce their tax. So it was not a success, to say the least. So this one applies to companies that have annual profits in excess of $1 billion annually. So really only the biggest companies. And initially it looked like it was going to apply to all differences between the way that you would calculate your profits for accounting purposes and the way that you would calculate it for tax purposes. But in the process of coming up with a statute, they exempted a whole bunch of stuff: asset depreciation, foreign tax credits, net operating losses, general business credits. And so essentially what you're left with is that this is a tax on stock-based compensation. So a company like Alphabet paid stock comp in 2021 was $15.4 billion. Amazon's was $12.8 billion. So these sorts of companies might have an issue with this tax.
Well, and that's separate from the 1% excise buyback tax, right?
Exactly.
So go ahead.
Those companies also have an issue.
Yeah, because they do a lot of buybacks. I mean, basically, a lot of industries are now doing buybacks because they didn't really know kind of what else to do with the capital. And I'm wondering, do they stop doing more buybacks? Are they forced to invest more in CapEx? Are they forced to do more dividends? What do you think the fallout's going to be from that?
Well, I think Congress would like them to do that.
Oh, sure.
But essentially, this is only a 1% tax. It's not that much money. I mean, it seems like a lot, right? Apple bought back $85.5 billion worth of shares last year. The buyback tax would have cost Apple $855 million. That seems like a lot, but Apple paid $25.4 billion in income tax last year. So this is really sort of just a penalty of more so than a tax. So I don't imagine that most companies are going to say, we have to change all of our behavior because of this 1% tax.
Andrew, I pulled this is what I thought was really interesting coming out of your research report. IRS Commissioner Charles Rettig told the Senate last year that the IRS fails to collect as much as $1 trillion of tax revenue annually due to Bitcoin and the gig economy. Why does that happen? And does this bill try to get some of that money?
Yes. So that's right. So what Commissioner Rettig calls that, and what most tax folks call that, is the tax gap. What the IRS thinks it should be collecting and what the IRS actually collects. And just in the past 5-10 years, Commissioner Rettig said that it's gone up from $500 billion a year to $1 trillion a year. And he attributes that to two things, which is the gig economy and crypto investment. And he said it's because mainly small businesses aren't reporting what they should be reporting on their tax returns. And with regard to crypto, he said, people just aren't, again, people aren't reporting what they should be reporting. But we actually didn't have those tax rules in place also. And so now that we have those in place, at least some of them in place, because of the Bipartisan Infrastructure Act, now we have the ability to collect those taxes.
Andrew, thanks so much. We really appreciate it. There's so much more to get through on this one. We'll continue the conversation. Andrew Silverman, Bloomberg Intelligence analyst.
All right, while we're talking about bills, another major piece of legislation in the works is the $740 billion Inflation Reduction Act. The renewable industry may benefit if it passes, while others, like Big Pharma, might not be so lucky. For more, let's bring in Bloomberg Intelligence senior government analyst Dwayne Wright. Dwayne, what's in this bill for the healthcare industry?
Good to join you. There's a couple of pieces, and if we start with the pharmaceutical side of things, the bill includes the Democrats' long-standing goal to rein in drug prices. There's a provision in the bill that would allow or require the Secretary of HHS to negotiate prices on some high-expenditure Part D and Part D drugs, and those prices would be available in the Medicare marketplace. Now, the bill is, and what's been proposed, is short of what Democrats had proposed in the past, but there are enough moderate Democrats in the House and in the Senate to scale back the proposal so that we're looking at least for the first couple of years, only a handful of products, 10 to 15 products that will be subject to negotiation. And again, those prices would be passed on to Medicare. The savings are not as big as what Democrats had hoped they'd see in previous proposals, but they are significant. It'll bring in about $100 billion in savings over the next 10 years, which will be used to either reduce the deficit or to pay for other items that are included in the bill.
So, Dwayne, I think what most families, maybe the only thing they can agree upon around the Thanksgiving table is that drug prices are too high. Is there a plan? Is there a path from a legislative perspective to get drug prices down?
Well, Democrats would say this is the path because what the bill would do is essentially say, look, we have these high-cost drugs that are on the marketplace. And in particular, we have these therapies that have been on the marketplace for a while. They don't have generic competition, and that's part of the reason why these costs are so high. So by allowing the Secretary of HHS, Medicare, to lower the prices, to negotiate lower prices, that should, in theory, bleed into what the average consumer would pay for these drugs. So the Democratic answer to that would be yes. It's a problem, and this is how we're going to solve the problem.
Are there certain companies, certain sectors within the healthcare space that are maybe net winners versus net losers?
Well, so if we look at the pharmaceutical space first, a lot of the initial losers will be some of the names we are very familiar with. So we modeled out a scenario where about 10 drugs would be the first to get negotiated in 2026 and have their prices cut. So looking at Pfizer and their breast cancer drug Ibrance, could see a 50% cut in prices. Xarelto from J&J, a blood thinner, could see 65%. And Symbicort from AstraZeneca for asthma and COPD, they could see a 60% cut. So the brand name manufacturers could see a cut in 2026. But if we're looking globally at the healthcare sector, it's important to keep in mind that there's a side of this where managed care companies come into play, and this is a separate provision that Democrats included in this package, which is to extend enhanced ACA Affordable Care Act subsidies for those enrolled in the ACA. Those subsidies were included in the American Rescue Package Act from 2021, but they expire at the end of 2022. And as it stands, those companies that are on the ACA marketplace, they're about to send out premium notices to individuals, and that's going to be in October. And they've warned, and we've seen some studies, that the estimates for premiums for next year could be 50% higher, leading to 3 million people losing coverage or dropping coverage because it's no longer affordable. So you have companies like Centene, who will benefit because they have roughly 14% of the market share on the ACA market. Right. And you have other companies like Elevance and Molina and Oscar who will stand to benefit as well.
All right, a lot of big numbers out there, a lot of moving pieces in healthcare, as there typically is. Our thanks to Bloomberg Intelligence Senior Government Analyst Dwayne Wright. That's this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. And remember, you can access Bloomberg Intelligence via BI Go on the terminal. I'm Paul Sweeney. It's 57 minutes past the hour, and this is Bloomberg.
I think it's just vapor.
Vaping is safer than smoking, isn't it?
One vape pod has as much nicotine as one pack of cigarettes. Get your head out of the cloud. Talk to your kid about vaping. Visit talkaboutvaping.org. Brought to you by the American Lung Association and the Ad Council.